Yep. Okay, I hope everybody had a good week and we're ready to, do you realize we're at the halfway mark now of our class? Hard to believe, halfway mark. So at the halfway mark, that means it's midterm examination time. And you will all be working on your midterm this week, which has been posted to Blackboard, but you will not see it till around 6:30 this evening. That's when it's shown. It's going to be uploaded to your Blackboard. And that work is due next Sunday evening, April 26th at 9 p.m. So you have a midterm examination. It's a midterm, so it's not what you call light work. It requires some time. So our job this evening is to go over the facets that make up that midterm examination. We'll do a quick review of quiz number 2. The grades have been posted to Blackboard. We'll also do a final review of Chapter 5 and look at problem 6-1A to determine inventory cost of sales analysis. So that's on our agenda for tonight. We also have our project paper, and I was going to do a project paper review format, but some of our students have yet to post their companies in the discussion board for the project paper. So I'm going to postpone that till next week. Hopefully by that time we'll have an idea of all the companies involved, and so I can give you some review notes and some ways of preparing for this project paper. There is a sample of the project paper, an example of a sample of a paper from a prior class posted to the paper file folder in Blackboard, where you can look at that. Remember, this work is not due until our last class, but it does require some time, and to chip away on it every week will be advisable as we move forward. So if you have not posted to the Blackboard discussion forum asking you for your company and the reason why you selected that company, please do so within the next couple of days so we can put that on our agenda for next week's class. All right, so double check that. Remember, this is part of your grade for the paper, and being late does not do justice to your grade for that paper. So make sure you post that work as soon as possible. All right, if you have any questions or concerns on that, please let me know. All right, let's take a look at quiz number 2. Again, all the grades have been posted. Everybody did a very good job on that of the papers that I looked at. If you want to know your grade, you can go to the Grade Center in Blackboard to see that. It is posted, and the solutions are posted in Blackboard. If you have not posted your work, please do so as soon as possible. I would appreciate that within the next day or so. Again, if you have any questions or comments, please feel free to let me know. So let's take a look at this. Excuse me. So as you can see, this is an Excel file, and it breaks down the quiz into various sections of which you're asked to do. And I apologize for this being rather small, but I need to do that in order to fit into the page. So if anybody can't exactly see it, please let me know, and I will make sure I make it a little bit larger. But this is the format that I'm going to be doing this evening. This quiz was asking you to put together some adjusting journal entries, prepare an adjusted trial balance, and prepare the necessary financial statements associated with that trial balance, and then also do some closing entries for a company. In the second part, to do the closing entries and the post-closing trial balances for that company. So let's take a look at it. Everybody, again, did very well. If you did not get your file back in your grade center, it's because you got 100 and you didn't need to see any corrections or examples that I gave you. So that's why you don't have a file returned. If you got 100, there was no mistakes. So you did very well. So let's take a look at this. Uh, again, you will have a problem again similar to this on the midterm examination, which will ask you to make sure you do the accounting cycle. There'll be one problem on the midterm for the accounting cycle. The same company, all the cycles throughout their accounting cycle you'll be asked to do on the midterm examination. Again, for many of us, Excel or a spreadsheet file is the best way of doing this work. It's a little bit easier to do the arithmetic, a little bit easier to organize the numbers. I would recommend spreadsheets for your work in this regard. So we look at the Glow Styling Company. Glow Styling had an unadjusted trial balance on December 31st of $131,870. And then you were asked to do a variety of adjusting entries based on adjustments that have been made due to the passage of time, inventories, depreciation, revenue turning into earned revenue, liabilities such as accrued expenses, wages, property taxes, and do those adjusting entries accordingly. The only one we really had a problem on in some cases was the store supplies expense, where it showed an inventory count of $210 of unused shop supplies still available. $210 is not the entry. $210 is what the adjusting entry will get that balance down to. If you notice in the unadjusted trial balance of this firm, there's a balance of $990 in shop supplies. If they say they're going to they have now an unused amount of $210, that means they used $780, the difference between $990 and $210. So debit shop supplies expense and credit shop supplies is the proper entry there. Once you do that entry, if you notice in the adjusted trial balance to the right, shop supplies has a balance of $210. We've adjusted the account for the inventory taken at the end of December. That's what the adjusting entry was all about. All the rest of the entries, everybody did pretty well on. Depreciation for both the shop equipment and the building using depreciation expense and accumulated depreciation, recording the use of the asset. The rent receivable and the rent earned, we recorded rental payments on this was accrued revenues showing the receivable, they owe us the money. They tell us that unearned account, $800 of the unearned rent account balance was earned by the end of the year end. So we now take it out of the unearned rent liability account by debiting it $800 and crediting rent earned $800, increasing. Now we have incurred new revenues of that liability now being provided. Then we record a variety of accruals, wage expenses, property taxes, and interest expenses, all liabilities, wages payable, property taxes payable, and interest payable. We've now adjusted all the accounts, and as you can see to the right, that adjustment now totals $135,890 of total adjusted trial balance. And from this information, you now can complete the income statement. Remember, the income statement is made up of all the revenue and expense accounts. The revenue and expense accounts. So the income statement shows the revenues, $26,800, and the expenses, $14,680. Thus, we have a net income of $12,120. Notice the income statement. A little bit of an error on this one. It should say Glow Styling income statement for the year ended December 31st. It's an error on this example. It should say for the year ending. If I read this statement the way it's shown now, it says, oh, they made $26,800 on December 31st. They made a profit on one day of $12,120. That's incorrect. It's for the year ended December 31st. Same thing with the statement of owner's equity for the year ended December 31st. We start out the year with $25,000 of equity. we have a capital balance in the account at the end, and our adjusted trial balance, notice 49,860 capital balance. We have net income of 12,120. That gives us 49,860 plus the profit, $61,980. Then we have the balance sheet, the assets and the liability. Excuse me. The assets and the liabilities. Cash, prepaid, $114,030 of cash. Notice how we handled the equipment account. Shop equipment less accumulated depreciation gives us the net value of the asset. Building less accumulated depreciation gives us the ending value of the building, $114,030. Total unearned rent, long-term notes payable, all the liabilities, $52,050. That is added to the capital balance that we did in the equity statement of $61,980, and we get $114,030. The balance sheet is in balance. So what we've done here is we've recorded adjusting entries, we've adjusted the accounts, and we took those adjusted account balances and prepared an income statement for year end, a statement of owner's equity for year end, and a balance sheet on the date of December 31st. The company now has a record of all the accounts of the year, and now they've shown they're public in nice financial statement format that they made a profit. This is the equity or the owner's position of the company, and that their books are in balance with the assets equaling the liabilities plus the equity. We all did this very well. Just a couple little minor errors in this, but we all did a very nice job in that. You are to be commended. This is our first real try at putting this together. You did a great job. Use this as a template in your midterm. The second question had to do with preparing closing entries for a company. The company was Paradise Travel, where I give you the adjusted trial balance on December 31st of $135,260. And our job here is to close out all the highlighted yellow accounts. Notice none of the balance sheet accounts are going to be closed. All the temporary accounts, withdrawals, revenues, expenses. And here's that closing entry here. We use the income summary account to close it out. The fees earned are debited. The expenses are credited. The difference in the income summary account between the total revenues and the total expenses is $14,640. That is closed out to the capital account. And then we close out the withdrawals to the capital account, crediting withdrawals and decreasing or debiting capital. This we go into our post-closing trial balance of $73,900, where all those balance sheet accounts are listed. The only addition is the capital account, because the capital account started out with a balance of $30,260. We add to it $14,640 of additional profits, and we get a withdrawal $1,000 as withdrawals. We get an ending balance of $43,900, and thus the closing balance, trial balance, is balanced. And that's the close of the accounting cycle. So quiz number 2 is asking you to do the last segment of the accounting cycle: adjustments, financials, closings. And these are perfect examples of this that you'll see again on the midterm examination. Does anybody have any questions or concerns about this work from quiz number 2? Okay, very good. So we'll move on. Again, these solutions will be posted in Blackboard, and you can review them as a study guide for your midterm that's due next weekend. Okay. So let's move along to something a little bit different. Let me bring up our Blackboard account here. Find it. One moment. There it is. Okay, here's our, oh, we have a chat question. Let me answer that first. Oh, okay, very good. First of all, a couple things to note in this Blackboard section, again, for you. You're looking for information, looking for results. Again, remember right here in the report card section, well, let me bring up this as a view in your format that we're looking at my format. That's not going to give you much information. All right, here we go. There we go. So here's our Blackboard account. And right here is the report card section. Oh, look at Mr. Hassey has an A so far. No, that's another class. So you would see your grade up to this point in the class. Right here, you can click on that grade and see all the details of your grade up going into the midterm examination. Remember, at the end of this midterm examination, we will have half of your course grade completed. Half of your course grade completed. The balance of your grade over the remaining 5 weeks of the course will be one more examination, will be your paper, and will be your class participation, probably in the format of a couple more or one more quiz to practice during the last 5 weeks. So we're halfway through in the calendar of our term, and basically we're halfway through in the grades of our term. Again, remember, not 6:30 yet, so you won't see it, but in the quiz and examination section, this is where you'll see the examination posted later on this evening. And as we all finish up our grades, you'll see the solutions to that information. Again, the project paper section has the overview of the project. It will also have a sample paper posted to that after I get all the all the companies selected by our students. I'll post a sample paper to that project file so you can see how it was done in prior classes. So tonight we're going to finish up in week number 5. The introduction video was given to you yesterday to give you a little beginning of what we're going to talk about, some information. And then we're going to review the final review and do one last time of retail and inventory accounting. And that'll get us all set up for the examination this week. Again, we will have office hours this week where you can participate Thursday evening from 7 to 9 o'clock. So if any of you are starting to work on the midterm examination, you can come on the office hours Thursday night and ask me any questions or concerns or anything else that is you need information from me.
Professor?
Yes.
You know how you showed the overview grade of the class? I couldn't get to that from my page, and I have my Blackboard open right now. Can you just repeat that step again?
Well, there's 2 ways of going there. You can go to the report card section and you'll see our class right here. Okay. Financial Managing Accounting, and there should be a letter grade there.
Okay.
And you click on that, that'll get you into the grade center. You also can go to the tools right here. This tools section, see what it has said my grades. You can click on that and that also gets you to your grade information.
Okay, perfect. Thank you.
Okay. Check on that after like for example, next week after I've graded and let you know that the grades are completed for the midterm, you go there and you'll see what your new grade average is. Now, sometimes that grade average will scare you because if you haven't posted work or if something is amiss, you should make sure that you understand why that grade is that way and do something, or either ask me about it or do something about it to fix that. And usually the way to fix that is to talk to me about it and see what we can do to make that grade better. Okay.
Perfect. All righty. Thank you.
Good question. All right. So now let's look at this here. One moment. Go back here. Remember last week we talked about retail accounting and we did some practice journal entries and practice work on retail accounting. This week let's review some of that work by bringing this up. One moment. Computer's very slow tonight. Must be a lot of people online. Very slow. I'm still here. Hang on, I'm waiting for the computer. Now it's firing up. There we go. There we go. Okay. Remember last week we talked about recording retail entries, and we're concerned about two methods by which we do it. Doesn't really mean much to you, but in this case anybody asks you, we're doing the perpetual and gross method of inventory entries. Perpetual means we're constantly updating the inventory as we proceed through the transactions. Inventory is always being upgraded. The gross method is we're recording all our sales at gross amounts. We're not taking out any discounts before we adjust our sales to discounts later on, but we're booking all the entries at their actual dollar values. So I'm not going to run through this individually, but just remember, we're recording the purchase of inventory, and the key determinants of our purchases now is we have terms of the sale, terms of the purchase. 1/15, net over 30. 1% discount if you pay it within 15 days of the invoice. If you don't pay it within 15 days of the invoice, the net is due in a month, 30 days. The same holds true if we're selling to somebody on account or with an invoice. Accounts receivable, sales is now our revenue line. And also we give our customers sales terms, in this case 2/10, net over 60. And here's something you have to remember after every sale transaction, and sometimes students forget this. When you record a sale of goods, either receiving cash or accounts receivable, you also have to record the cost of goods sold or the expense of the goods being sold, because it's no longer in our possession. We've transferred it to somebody else who's given us money for it. In the example here on July 2nd, they gave us $900. In return, that now is costing us $500 in inventory. Now we're recording the expense, cost of goods sold, and reducing inventory because we no longer own it. That's a very important thing to remember about retail accounting. Revenue also precedes the entry for cost or expense. Have to remember that. The rest of transactions are very similar. Here we're recording a sale of some product, and we receive not receivable, but cash. And at the same time, we record the expense of the good. Cost of goods sold is the expense of the cost of the inventory we purchased that we sold. And the rest of the end transactions are pretty similar, except remember sales discounts. If you fall within a discount period, you got to record the discount, thus reducing the amount you have to pay off, or if they pay you, of the sale or the invoice. The same thing holds true with accounts payable. You can get discounts right here. Accounts payable is getting a merchandise. We're paying off a debt of inventory. We paid within the discount period. We get 1%. Thus, we only have to pay $5,940. This is why this is called the perpetual method. We're constantly changing the inventory with the buying or selling of our merchandise, of our product. Last area that can perhaps maybe confuse people is, again, when we have sales discounts, when we give somebody incentive for paying us early. Those sales discounts are a debit to a revenue account, sales discounts, and thus reducing the amount of cash we're going to get. That's incentive, though, for them to pay us early. All right. So that's what the problem we did last week. That was the problem 5-1A that we looked at last week. Now I want to take a look at another problem from that area. easier to see. There we go. This is a income statement of a retail company, and I wanted to show this to you again because I wanted you to understand what those transactions and those journal entries will produce in the form of a financial statement for a retail company. Notice this is for the Valley Company in problem 5-3A. Notice how they do the revenue. Sales are, which is a credit balance in our ledger of 225,600. Then we have those sales discounts and sales returns accounts that have debit balances. They thus reduce the overall gross sales to a net sales, taking out the discounts and the returns from the amount that we actually sold those products for and giving us a net sales. Then we have that entry or that balance of cost of goods sold. And this area here is a very important part of retail accounting statements. The gross profit, the difference between what we sell a product at, net sales, and what it cost us to buy the product that we sold to our customer. And that is called the gross profit. Some people call it the gross margin. It's the difference between selling price and cost of the merchandise. That's important. And then now notice the other expenses of the company are split by selling and G&A, general and administrative. What it cost us to sell our product, what it cost to administer our company. The net effect is total expenses of 87,000, selling plus G&A, and that equals the net income. That total expenses is subtracted from the gross profit to give us our net profit. These days in the retail industry, net income is probably a net loss, but we'll talk about that at another day. Hopefully that gets fixed. But this is what is called a multi-step income statement. If I ever ask you to prepare a multi-step income statement, it's a statement showing different levels of the business. Net sales, gross profit, selling expenses, G&A, general and administrative expenses, and net profit. That's called a multi-step. It shows different levels of the company. And that's a very important statement for investors, for managers of the company to see. It's called a multi-step income statement. This is a single step income statement. It's the same statement here, but notice how much easier it is. Geez, Mr. Hassey, I hope you give us one of these. The single step income statement is just showing sales, net sales, expenses by cost of goods sold, selling and G&A, and profit. It doesn't give all the details of these various areas. So one of the key parts of chapter 5 is, geez, do you want a multi-step income statement or do you want a single step income statement? If I was a betting man or woman, I probably would want the multi-step income statement because it gives me more details of what makes up these numbers, which is kind of important. But also it can be in this format of a single step, and that's just something to remember, that it can be this easy where you don't have to put all the information down. Some companies do single step income statement, especially smaller companies, when they're not too concerned or they don't have that many detailed accounts of these various expenses. So that's a couple final points about chapter 5 to remember, is the income statement of way of showing your data can be in a multi-step format or in a single step format. These solutions are in Blackboard. They can be a study guide if I perhaps ask you about these questions on the exam. Now let's take a look now at chapter 6 and that inventory, and more specifically on page 248 of your textbook, problem 6-1A. All right. Remember, chapter 5 is about the basic transactions of retail. The basic transactions of retail and how to show those transactions in the retail way. And we did that in problem 5-1A. Also, chapter 5 is about explaining how the financial statements, their income statement looks like for a retail company. In chapter 6, we now want to calculate how do we determine the value of an ending inventory. And there's a variety of different ways of doing that. In the introduction video that I gave you yesterday, Sunday, there was a nice short little piece by the publisher of this textbook on the definition of that inventory accounting. You might want to look at that. Also, I'm going to show you a video. See if I can get that. Hang on. I think I'll do, oh yeah, here it is. Bring this up. There we go. This is our YouTube site, and I hope some of you are every now and then going to this site, because in this site I give you our introduction videos, I give you our class recording videos so you can review class work, and I give you videos explaining the nature of inventory valuation. And in inventory valuation, this is a very good video that we saw last week about the different methods of inventory valuation, and also this video on yesterday's introduction that summarized that as well. In chapter 6, we're learning how to determine the cost of our inventory using 3 different methods: FIFO, LIFO, and weighted average. Those 3 methods can be selected by a retail company to calculate the cost of their inventory. And problem 6-1A is a perfect example of those 3 methods of how to do that. Trust me, you can go to the bank on this one. You're going to have a problem exactly like this on your midterm examination, where I give you a company's purchases and sales of their products, and you are to determine what is the ending valuation at the end of that period of their inventory, the amount of units they have remaining, either by the first in, first out method, the last in, first out method, or the weighted average method. So in the process of your studying this next week, or the process of reviewing, go back to these videos in our YouTube site, and they can help you review and study that material. It can be a nice little guide to help you if you get a little confused. But sometimes if you don't want to do that, you can just contact me and I can explain it to you as well. So don't forget that as well. Okay, so that's YouTube, and that's something that you should be looking at every now and then to check out. Now let's look at problem 6-1A on 248. If any of you have a textbook, this is a problem that's where a company, Warner Woods Company, is wanting you to determine their ending inventory value based on sales that begin on March 1st with their beginning inventory of 100 units, and then purchases on March 5th, 18th, and 25th. Purchases of the same product, but at different dollar amounts. And then the sales of those products on March 9th and March 29th. What is the ending value of those inventory units that are end of the period? That's what we're trying to find out here. Now, again, as it said in that video I gave you yesterday, the reason why companies have this way of calculating ending inventory is because due to the nature of their products, their business, their market, their industry, prices change over the course of an accounting period. If they can measure those changes of those products accurately, they can save some money on their accounting records by doing these valuations. So let's see how that looks like. Let's bring this up. All right. So as I said on page 248, a company has a beginning inventory of 100 units at a value of $50. That's $5,000. On March 5th, they purchase 400 units at $55. That's $22,000. On March 18th, they have 120 units purchased at $60, $7,200. And on March 25th, they purchase another, excuse me, I have to take a drink of water. They purchased 200 units at $62, $12,400. That's a total 820 units they purchased during the month of March for a total cost or goods available for sale of $46,600. Well, they purchased 820 units, and if you look at the transactions on March 9th, 420 units, and look at the transactions on March 29th, 160 units, they sold 580 units. That means they have an ending inventory of 240 units. Our job, even though we don't want to do it, as managerial accountants, is what is the dollar value of that 240 units? What is the dollar value? And we have three methods of calculating that dollar value. Each method gives us a different amount. Kind of weird, but it's true. And so our job in Chapter 6 is to determine, okay, based on this information, what is the value of those remaining units, 240? Remember, the Fifo method of inventory is goods purchased first are the first ones sold. The ending inventory is made of the ending value of the inventory, of the purchases. First in, first out, sold. So if we have 240 units remaining at the end of the period, those 240 units are made up of 200 units on March 25th and 40 units on March 18th. First in, first out, the 240 is the most recent purchases into the inventory. And here it is, that transaction here. We show the units being sold in March. We sold the units, see the units, and now we have an ending unit value. Notice I said we have 200 units at $62, and we have 40 units at $60. All right, we total that up, see, as I said earlier, 200 units at $62, 40 units at $60, all right? That which makes up our ending inventory. And that amount is $14,800. That's the inventory balance at the end of the period. 40 units at $60, 200 units at $62, add them up, $14,800. Of our total goods available for sale, which was $46,600, $14,800 is the ending value of the inventory. The difference is our cost of goods sold, $31,008. That's what makes up the $46,600. So the answer to the problem is, under FIFO, those 240 units are at $14,800. Now, LIFO is the direct opposite. Goods purchased last are the first ones sold. Last in, first out. So your ending inventory value is the older of the units in inventory. In this case, remember we had 240 units in the inventory count, 100 units at $50, and 140 units at $55. That's our ending inventory under LIFO. The last in, first out, that means the earliest inventory items are part of that 240 unit ending. Put that into our analysis. As we said, notice we have the ending inventory of 240 units is made up of last in, first out. Goods coming in last are the first ones sold. All right, so 100 units at $50. And so on. last in, first out. We end up with an inventory value, whoop, where'd it go? Here it is, of $13,680. Our ending inventory balance, the difference between that and the 46,006 is our cost of goods sold. The weighted average is averaging the purchases. March 5th, we bought 400 units at $55. We had the beginning inventory of 100 units at 50. That's an average of $54. We keep that, and notice the averages, 57.60. We have the averages, 59.80. We take those averages and we determine an average cost per unit during the period. Take that average, and that becomes our ending inventory. The average of all the products produced or purchased, 59.80 times 240, 14,352. So in other words, we take the average, we total up all these and determine the average cost per unit. In this case, it's $59.80. So what we're doing here is we're trying to determine the value of ending inventory under a variety of 3 different methods. Our job as accountants is to determine which one of those methods is the most expensive or the cheapest. Because as I show you here, the more expensive the inventory, the less the expense. The more expensive the ending inventory, the less the cost of goods sold. So many times companies will want to pick the inventory valuation that has the highest value because that means the expense amount will be less and they're making more profit. Other times a company might pick the smallest amount. In this case, it's LIFO, 13,680. That will give them a higher cost of goods, thus reducing their profits, but maybe they're making so many profits, they don't want to record all those profits, so they're going to reduce their tax liability by having that additional cost of goods sold. The lower the inventory value gives a higher expense amount, thus reducing profits. Yes, most companies want to show a lot of profit, but at the same time, most companies, if they're very successful, they might be saying, well, why should we pay more taxes? Let's have a lower inventory, or excuse me, a higher inventory value to reduce our expenses and thus reduce our taxes. Depends on the culture of the company, and it depends on the industry that company is in. Certain types of retail companies record these differently. So the key of Chapter 6 is to breaking down the purchase of merchandise. Now, naturally, if you had the same purchase price, $50, let's say, of all of them, you wouldn't have to do this. But because we buy product at different time periods, many times the vendors will change the prices. Will change the prices, and thus that means the same product comes into your inventory system at different rates.
So, Professor, this is Kathy.
Hi, Kathy.
Hi. So can I ask a question on the first in, first out, and then on the was it LIFO?
That's okay.
Okay. I just want to make sure that I'm understanding this. So, I mean, we break down the inventory and we're looking at the cost. We know that we have, is it 200? We had 240 left over. Is that correct for the FIFO?
Yes, that's how we calculate that. We purchased 820, we sold 580,
Okay.
we have 240. Yes.
Okay. So we purchased. Okay. So basically, you added up the total amount that you purchased, and then how much you sold, and then you get your remainder. Correct. And then for the 240, when we're figuring out the cost there, you starting at the first in, first out, you would take the first 100 off of the, and whatever that price was that we paid, the $50 per unit. And then would we take the next 140 off of the 400?
No, you're doing LIFO here. This is FIFO. FIFO says that the goods here, these original units, they're sold
Yeah.
first. They're sold first.
Yeah.
So your ending inventory is made up of the 200 units at $62 and 40 of the units of March 18th at $60. That makes up the ending inventory of 240.
So, okay, so first in, first out. So we're saying that to calculate that, you're going to take it from the bottom. Is that correct?
Yeah. First in means goods
Okay.
first in are the first ones sold. So
Okay.
what's your ending
Okay.
inventory? The last ones in.
Okay.
Make sense?
Okay.
Okay.
Yeah. Yeah, it does. Yeah, it does. And
it's
so
a-
then,
Go ahead.
oh, and then for the, so I get that part. I do get that now. I understand the difference between that. And then for the other one, for the LIFO, we,
Last in, first out. So your inventory is made up of the earliest items.
okay, so you're taking that's when you're taking the 240 off of the first ones coming in. So you take it off of 100 off of the $50 units and then 140 off of the, is that correct?
That's correct. So,
Okay.
so remember, and this is the calculation for that. And I'm here now. I'm in the LIFO section here. Okay. So look,
Okay.
here we have the beginning inventory. Then we purchase 400 more. So now we have 500 in inventory in stock. All right. Then we sell 400 of those. All right. The 400 will be made up of, 400. Yeah, 400 at 400. We sell 420. So 400 would be at this amount, cost of goods sold.
Okay.
And then 20 of the $100 amount of the 100. So that means there's 80 left at $50.
Okay.
All right. Then we go
Okay.
down and we keep following that pattern. And then we go down to the next, then we purchase another 120. All right. We purchase another, there's our inventory. Then we purchase another 200. And now we sell 160. All right. So we're going to sell 160 of the 200. That's 40. All right. So that leaves us with 40 units at 62, 120 at 60, and 80 at 50. 80, 120, 40, that's 240, and our value is 13,680. Last in, first out. So our,
Okay.
all right, it's just the opposite.
Okay.
People do this for a living. Trust me. Pretty wacky, huh? And that's why I was talking last week about the beep. All these products have the beep, and the beep automatically calculates this. If they're under the LIFO calculation or the FIFO calculation, the beep is set up in the computer to figure this out. So going back through, I sense confusion, but going back through it, under FIFO, goods first in are the first ones sold. So at the ending inventory of 240 units would be, we haven't sold these 200 units we purchased on March 25th yet. So that's $62. And we've sold all the rest of them except for 40 units of the $60 unit. 40 at 60, 200 at 62, 14.8. Under LIFO, last in, first out. So goods purchased last are staying here. So we're concerned about these goods up here that haven't been sold yet. 80 units at 50, 120 at 60, 40 at 62. All the rest, last in, first out, last in, first out. So the earliest purchases are accounted for. The weighted average is taking the average throughout the whole period, which is $59.80, and multiplying it times the 240, taking the average of every purchase, dividing it by the dollar amounts in the units, you get an average of $59.80. That's your value times 240. That's the average cost method.
No, the weighted average I get. That was easy. The other one I was just, my hesitation before was just I was just processing.
Yeah.
I'm just processing and kind of matching things up.
Sure.
So.
Okay.
Yeah. Yes, I'm good. Thank you.
Okay. But use this sheet. Download it or print it out. It'll be a good reference to help you.
Okay. Thank you.
Okay. Now, a couple of things as a result of this. Once we determine that inventory valuation, all right, we have goods available for sale, which is all the products we have available for sale. That's $46,600. That's no problem. Then once we determine an inventory valuation, let's say in the case of FIFO, it was $14,680. The difference between the ending inventory value and the goods available for sale have to be the cost of goods sold. That's an important product. And when we looked at in the later on in chapter 5, when we saw that multi-step income statement, sales minus cost of goods sold is the gross profit of the company. There's a problem in the midterm where you have to reconstruct that financial statement based on understanding what makes up those multi-step layers. I shouldn't have probably told you this, but you can look at that examination now because it's already posted in Blackboard. And we'll look at that in just a few minutes after our break, the exam. So that's something that you need to understand, that correlation of if we have goods available for sale and we know what our ending inventory value is, the difference has to be cost of goods sold. And we'll take a look at that after break. Okay. Clear as mud. All right, let's take about a 10-minute break. And when we come back, we're going to take a look at a little review for the midterm examination. Now, the midterm examination, and I don't want to scare you guys or give you anything, but the midterm examination is designed because you're not in a classroom, right? If we were in the classroom in Burbank for this class tonight, you would have the midterm examination and you would be in the classroom for roughly 3 to 4 hours doing this examination. But since this is online, you're going to spend 3 or 4 hours outside of the classroom to put this together. So that's why in my regard, I think you would rather be able to do it at your own pace outside of the classroom instead of being stuck in a classroom in Burbank for 3.5 hours trying to figure out this problem, and you have to do it right then and there. Here you have more time, and that's the advantage that you have. You have more time, and you can do part of the problems one day, part of the problems another day. I would strongly advise you next Sunday afternoon to all of a sudden just say, okay, Mr. Hassey's done tonight, Monday night, I'll see you later, and I'm going to do this on next Sunday afternoon. If you decide to do that way, it's going to take you 5 hours to do the examination. Why? Because you're going to forget about some of the stuff we talked about tonight, and then you're going to have to go back and look it up, look at the templates, look at the solutions, look at your quizzes, and sort it out. It'll take you a lot longer. If you do this in segments during the course of the week, trust me, if you can do that, it'll save you a lot of time. But don't wait till Sunday afternoon. Oh, Hassey's exam is due at 9 o'clock tonight. I guess I better start working on it. You're going to take a look at it and you're going to go, holy fruit, this is going to take me a while. I strongly urge you to do it in segments. It makes it a lot easier and you'll do a lot better. And I'll explain that to you a little bit more when we come back from our break. All right, I'll see you back here about 7:10. Thanks, everybody. See you in a minute. Okay, we're back. Nice to see you, Barbara, with your LA Dodger t-shirt. That's very nice. I can't see anybody else. Tori, show yourself. Gabriella.
I'm
Marianne.
here, Professor.
Vince, are you here?
I'm here, sir.
Very good. Thank you. All right. Thank
Hi,
you.
Kathy
Yeah,
Kim.
Professor.
Kathy's
There's
here.
Gabriella. Look at that. There's Gabriella. Very nice.
And Kathy's here.
Gabriella. All right. Thank you all. Just want to make sure you're all with me. Not either jumping out the window or falling asleep on me. I just want to make sure.
No, we're here. We're here.
Okay. All right. Let's look at a couple things here. This midterm examination I have some good news and bad news. The midterm examination is a lot of work. That's the bad news. The good news is after this examination, your days of doing journal entries are almost over. Almost over. Because from now on, after the midterm, we will be studying managerial accounting, not financial accounting. This is financial accounting. Managerial accounting is what we do next. Controls, reconciliations, variance analysis, budgets, fixed assets. That's what we study next. Now, there are a couple of journal entries involved there, but most of our journal entry days are pretty well over. So the midterm examination is split into two problems, two sections, basically. First one is completing the accounting cycle. This is taken out of our Blackboard week 3 file folder, where I gave you the makeup of the accounting cycle, chapter 2, 3, and 4. We've done this in quizzes. You're going to do this for one company in the midterm. And that puts a little bit of a pressure on you because if you make an error in the original journal entries or the trial balance, that error will exist throughout the rest of the segment. Now, I don't grade it that difficult or be that hard. Once you make the error the first time, I don't track it through, but it does pose a problem. It puts a lot of pressure on you to make sure you do the original parts of the transactions correctly. So read the problem carefully and do that. This is one part of the midterm. The second part of the midterm is about what we just discussed this evening and last week, retail and inventory. So that's how the midterm is split up. This is what the midterm looks like. It's now available in Blackboard. It is, again, split up and where I give you all the information, the chart of accounts, the accounts that you'll be using for this company called Reggie Dunlop. And Reggie Dunlop, you are asked to do the journal entries. There's the general journal entries. We've seen these many times before. So you record these journal entries. Then you create a general ledger. You post these entries to the general ledger and then prepare an unadjusted trial balance. So question number 1 is 3 parts. Record the journal entries, prepare a ledger, and then prepare an unadjusted trial balance. From that, you take that unadjusted trial balance and prepare the adjusting journal entries. Here they are right here. Same company. Now you record these adjusting entries, post them, and create an adjusted trial balance. Adjustments, post to an adjusted trial balance. Then you take that adjusted trial balance and prepare the financial statements for the company, Reggie Dunlop. Income statement, statement of owner's equity, and the balance sheet. Once you do that, then you prepare the closing entries and prepare one last post-closing trial balance. The complete accounting cycle in one company, one area. not split like we've done in quizzes 1 and 2, but combined into one area. But it's the same thing, the same work. It's all just with one company. That's one part of the midterm. The second part of the midterm is chapters 5 and 6. Okay. What I urge you to do is probably either, depending on how you feel your knowledge is do the accounting cycle first or do the accounting cycle last. Whatever is easiest for you, but get this out of the way at some point by yourself. This goes back to what I was saying earlier. Don't try to do all this examination in one sitting. It's going to put too much pressure on you time-wise and you'll get tired and you'll make maybe some mistakes. Question number 4 of the midterm is on retail accounting. And we've done this in problem 5-1, where you record the transactions, these transactions in journal entry format for this retail company, margin company. Record these transactions. That's the second part. Then there's a second part to this. I give you a financial statement for another company with certain areas blank. A, B, C. These areas are blank. The second part of this question is to fill these blank areas with the correct numbers to complete this financial statement. Fill in what should be A, B, C, D, and E. Fill in those blanks so they match the numbers already given to you. This is an assessment of your knowledge of an income statement for a retail company. So question 4 is journal entries of a separate company. You don't have to do, all you have to do is the journal entries, nothing else. And the second part is fill in these blanks in this retail company's financial statement. Question number 5, and the last one, is to prepare the inventory valuation and tell me the cost of goods sold. Determine the ending inventory and the cost of goods sold for this company using FIFO, the same company using LIFO, and then a different company using weighted average. And this one, question C, you just have to tell me the ending inventory value method. You do not have to do the cost of goods sold. The cost of goods sold for these two. And that's the midterm exam. So I would kick these out of the way maybe first, since it may be fresher in your mind, or you do the accounting cycle problem. You do that. But again, I urge you not to try to do these in one sitting. Now, if we were in the Burbank classroom tonight for your midterm, this examination would probably be chopped into maybe 2/3 of what you see, because you just wouldn't have enough time. But since you have some time, we're going to complete the problems as done on this midterm for next Sunday. Now, when it comes to Sunday, and it comes time to getting ready and posting your answers, all right? And if you feel that you need extra time, let me know. You can have extra time, all right? So if it comes the weekend, and I know you guys are very busy and you got a lot of things happening, if you need extra time to post your work, all you have to do is let me know. But you got to let me know, because if you don't, you'll go into this file folder on Monday and it will be locked. You won't be able to post anything, and you're going to get mad at me. So just let me know that you need extra time, and I'll undo that lock so you can post at the time you would like. That's the midterm. And again, remember, the midterm examination is located in our Blackboard under exam quizzes and examinations, and you would take your work. I give you 2 files of information. One's a Word doc file, one's a PDF file. They're both the same file. The same net information is just in different formats. But notice I say here, the preferred format is spreadsheet. You're going to have to do journal entries. You don't have to do the journal entries and all this work in Excel and then cut and paste into a Word document. You don't have to do that. Just give me the spreadsheet file with all your work. That would be sufficient. So you post it to this file folder, open it up and post it and upload the file and post it by next Sunday. And again, if you need extra time, just let me know. It makes no difference of your grade. It gives you some extra time because you might need extra time. Just let me know and that's fine. Now, in addition to this week, sorry, in addition to doing the midterm this week, we also have to do some additional reading. And we're going to do the reading to start our second half of our course. And that reading is this. But the good thing about it is Professor Hassey is going to tell you which sections to read in these chapters. You're not going to be asked to read the whole chapters, just certain sections of these chapters. Oops, wrong chapter. There we go. Sorry, guys, I'm having a little technical difficulties. Bear with me. There we go. Barbara, do you see chapter 8 on your screen? Okay, thank you. Thank you. All right, chapter 8. Again, as I said, now that we're done with the accounting cycle and retail accounting, now we move on to the managerial side of our course, managerial accounting. And chapter 8 and 9 is the beginning of that managerial side. I'm sure a lot of you work for companies, especially if you're in the retail business or if you're in a manufacturing business, you're always having internal controls. You're always concerned about reconciling accounts, making sure what you have is correct. And in this is what chapter 8 is about, is ability to control our numbers, making sure we're safe. Example, I would be very upset if my wife came to me tomorrow and said, Rick, I have not reconciled our bank account in 1 year. You haven't reconciled your checkbook in over a year? How do you know you have that? How do you know how much money you have if you haven't reconciled? Well, it's the same thing with corporations and companies. They're required by ethics, by business, to reconcile their cash accounts and make sure they have the correct amount of cash on hand. Because remember, cash control is the most important control for any company. Well, in chapter 8, I would like you to be responsible for the following pages. Write this down. Pages 298 to page 305. 298 to page 305. 7 pages. And those 7 pages concern itself with monitoring the cash position of a company. Petty cash and checking account cash. Pages 298 to 305. That's all your responsibility are for chapter 8. And that's a lot of responsibility because we're going to learn how to make sure we understand the reconciliation of cash and the aspect of control within our organization. If you're going to run an organization, you have to be able to tell your investors, your creditors, your employees, your managers, that everybody has a handle on how everything is working in your company. Many large companies have what is called internal auditors. These control agents make sure that you're keeping adequate records. You're reconciling accounts, assets. You're making sure that you can tell the outside world that you know what you're doing. And these reconciliations of cash and control is to reduce theft. I think almost, I think I can say this, at least once a week, you can read in the LA Times or newspapers in this area, somebody being arrested for fraud, somebody being arrested for embezzlement, somebody being arrested for lying and withholding information from regulators. Happens every week in companies. That technology, that fraud, and that internal control is a key part of internal control of a company to tell the world that you're managing your business efficiently. And one of the key parts of this are in pages 298 to 305. Controlling cash. Making sure what you have in cash is what you have in cash. All right? Page 298 talks about petty cash. I'm sure a lot of you might work for companies where you have petty cash, where you, geez, I got to go out and get something quickly. Can I just take some cash, bring back the receipt? You put that receipt into your petty cash drawer, you've reconciled it. Also, many of us have checking accounts where we write checks for companies, the recording of deposits. We get bank statements. Are those bank statements matching our cash account? It's called controlling cash. We need to be familiar with that, and that's on pages 298 to 305. How we reconcile money. It's called cash management. Do we know where our cash is? That's the most important thing out of chapter 8 is understanding the management of cash. How do we do that? We record when we keep receipts. We make sure that our cash drawers are balanced at the end of every night. We make sure that our petty cash is balanced every day or at least once a week. We make sure that our money is where it is. Is it at the bank? Is it in our cash drawers? Is it in petty cash? The reconciling of disbursements. When we write a check, when has it cleared the bank? When has it been cashed? Do you realize most companies have, major American corporations have millions of dollars in outstanding checks? Checks that they have written, credited their cash account, that they have yet to be cashed by the people who they wrote the checks to. Outstanding checks. You need to keep track of that. How many checks you have outstanding. You have to make sure that you keep track of your money to make sure you have control of your cash. Chapter 8 is about control. I wouldn't want to work or invest in a company that if you go up to the controller or anybody in the business and say, hey, how much money do you have in your bank account? I have no idea. How much money do you have in your cash general ledger account? I have no idea. Does the money in your cash general ledger account match the bank statement account? I have no idea. I don't think I would be wanting to do business with that company very well if they weren't keeping track of their cash. We're going to be taking a look at that next week. The definition of controlling cash in chapter 8. We're going to be looking at a couple of problems in that regard. Problem 8-4A. 8-4A we'll look at for next week of practicing cash control, reconciling cash. Then we shift our controls and our controlling to accounts receivables. One of the biggest reasons that companies fail, trust me, is having lack of capital, money. And one of the main reasons they don't have capital or money is they don't collect their receivables. People who owe them money, they don't collect them or they're doing a poor job. Chapter 9 is about understanding controlling of receivables. And the pages you need to be familiar with there are pages 327 to 340. A little bit more pages there. 327 to 340. 298 to 305 in Chapter 8. 327 to 340 in Chapter 9. Those are the pages you need to be responsible from those chapters. Get a little break with 8 and 9. That's the key part of those chapters. And here we're understanding how to keep track of receivables. If any of you work for companies in the collection of invoices, you have what is called an aging list. An aging list is telling you how outstanding the receivables are in your company. Current, 30 days, 60 days, 90 days, 120 days, deadbeats, all right? That's the aging list of receivables. How do we control these receivables? How do we manage them? How do we control these receivables to understand what they do? And at the same time, when do we have to write these off? Write off receivables. I was reading the LA Times this Sunday, and they told me in the LA Times there was an article that Wells Fargo set aside $2 billion as a write-off of bad loans because of the coronavirus. $2 billion. What does that mean? They're writing off those balances because people will never pay them. They're in default. $2 billion. Now, that doesn't mean the people still don't owe the money. But Wells Fargo is making a statement that they're writing off that amount of money because they anticipate never getting it. And this is one of the key parts of accounts receivable. How much do we have to collect and how much are uncollectible? And it's called writing off bad debts. There will be some journal entries involved in this discussion. But you need to read that section of 327 to 340. It talks about accounting for accounts receivable. Because most companies fail because they don't collect and understand the collections of their receivables. Trust me, bad part of business if you can't manage that accordingly. And also it tells you which customers you can rely on to pay off their debts, their receivables. And maybe you don't want to do business with those customers who constantly have a lot of receivables that they don't pay. So accounts cash, Chapter 8, accounts receivable, Chapter 9 are key parts of our discussion in class next week. Right? And those pages that I gave you are your responsibility to read for chapters 8 and 9. Chapter 8, we'll do problem 8-4 in class next week. And chapter 9, we'll do problems 9-1 and 9-2 next week in class. That will practice us up. And what we're doing now is we're getting ready for our next quiz, which will be May 4th, and our final examination, which will be May 18th. Quiz 3 on May 4th will be on chapters 8, 9, and 10. And we'll talk more about that as we go forward. But let's get through the midterm this week and read chapters 8 and 9, those sections, and we'll discuss those next week.
Professor, when is the final? What date?
The final is given to you on May 18th, and it is due May 25th.
Okay. Professor, regarding the project that we have to do, are we going to have to do a presentation about that project?
No, all you have to do is the paper.
Okay, great, thank you.
Okay. So that's where we're headed for the balance of our course. Chapters 8 and 9 for next week and the midterm examination, and then we go forward. Fixed assets, liabilities, we learn about how to manage those things. That's the managerial side of our class. The first 5 weeks are the accounting cycle. The last 5 weeks are managerial accounting, controlling, efficiency, quality assurance, management. That's the second half of our class. And we summarize, yes.
I'm sorry. And then the final, is it an accumulation or is it just on the last half?
Just on the last half.
Okay.
Is that good or bad?
In some hands, I think that's pretty good.
Okay.
So,
I hope so. If anybody wants a comprehensive final, lots of luck to that one.
no, I'm good. I'm really good. I thank you.
Okay. So as I said earlier, we're about halfway through with our grading. So we have a quiz, we have an exam, and we have a paper in the second half of our course. Our last day of class is May 25th. On that date, you will post your final examination, and on that date, you will post your paper. And that last class will be reviewing and discussing those two aspects of your assessment. And then we're done. Goes by pretty fast doing this, really does. Okay, any other questions on our work or anything else? All right, I'm going to cut you guys loose.
Yes. I'm sorry, Professor, this is Kathy. You have office hours on Thursday. Do we sign up online again like we did last time, or do you send you an email, or how do you want to do that?
You just show up between 7 and 9 o'clock.
Professor,
Yes.
in regards to that time on Thursdays, will you have any additional time beside Thursday to meet? Just because.
You just let me know your schedule and I'll make the time.
Okay, perfect.
You just let me know. Okay.
Sir, I have a question. Earlier in the lecture, you mentioned about how companies that are making a lot of money, in order for them not to pay so many taxes, they spend money on product, So that's on product, they spend money on the company, so they won't have to pay so many taxes.
Yes.
So is that only for big companies, and isn't it still income? Don't they still have to report their income?
Yes,
They're still making a profit,
Yeah, well, remember, any business, it can be a small or a large company. If they have expenses that they have to spend in order to sell their product, those are what are called business expenses, or tax deductible. They reduce your tax liability. So if you are, you can have a lot of cash flow, but you also can have low profits because you're expensing a lot of your expenses as tax write-offs, lowering your tax liability. But at the same time, you still have to make enough profit to satisfy the needs of your investors to pay dividends or to pay off debts and that sort of thing. You kind of find the balance, Barbara. You find that happy balance. It's just like, I know a lot of you probably, when you do your taxes, if you've already done your taxes, you put in your taxes, you have your revenue, your adjusted gross income, right? And then you have expenses. Well, most of us have what are called the standard deductions. Those are our expenses. But if you have a business, or if you have a lot of individual expenses like medical, interest expenses, travel expenses, that sort of thing, you have more of those expenses, you don't need the standard deduction. You can get less, you can pay less taxes by reporting those expenses as tax deductions. Does that make sense?
Yeah. Mm-hmm. Yeah, that makes sense. Okay.
And companies major corporations are the same way. Yeah.
Okay.
That's a good question, Barbara. Very good. It's a very good question. So it's the same for small businesses, for individuals, for big corporations. If you have the expenses to match, they are deductible. Here's the key question though, especially for us, are those legitimate expenses? Will the IRS accept those as business or personal deductions? That's another thing. Just ask Donald Trump about that. One of the reasons why he doesn't show his tax returns is I bet you he's pretty fast and loose with his deductions.
Oh yeah, no doubt.
So that's that.
Thank you for the answer.
Okay, Barbara, very good. So as I was saying before, we have this midterm this week, and I'm going to cut you loose a little bit earlier tonight because I know you're going to be spending an awful lot of time on this examination this week. And also, it might be a good idea if we have the next hour, you might set up your examination or download it, print it out, get it all ready, maybe even start taking a look at it and begin it while it's fresh in your mind. Get it out of the way. Or that's okay if you don't do that, but just make sure you give yourself adequate time and don't wait to the last minute because then you're going to get frustrated. And also remember, we have office hours Thursday nights on WebEx. The link is in Blackboard from 7 to 9 p.m. And you can come on anytime. I'm just sitting there in front of my computer staring at it, waiting for you guys to come on. And if you might by that time Thursday, you might have looked through your examination. And if you have any questions, you can ask me about that on Thursday. That might be a good way of doing it. Okay, well, that's all. Let me just sign this off here. And remember, I've recorded this tonight, so you can make sure and I'm going to upload it to YouTube, and the link will be in Blackboard tomorrow morning. And you can replay that if you need help with your review. But again, most students would like to come on, I urge you to come on during the office hours Thursday night. And if somebody can't come on Thursday night, send me a little email and say, Mr. Hassey, are you available? Blah, 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 blah. And I say I am, and I'll send you a link, and we'll have an office hour at that time. Just let me know your schedule. All right, everybody. Thanks for this. Thanks for the first 5 weeks. You guys done very well. You've done very well. You've begun to learn the accounting language. I know some of you are saying, yeah, I don't know what's going on. You do. By the work on your quiz, you guys are doing well. This is the final test this week with the midterm, and I'll see you guys all next Monday, or maybe I'll see some of you Thursday night. So thanks, everybody. Take it easy.
Professor.
Good luck with your good luck with your midterm. And remember to post your project paper companies, please. Don't forget that. All right, thanks, guys. Adios. Bye-bye.